next guest just raised her year-end S&P 500 price target to 4,600 from 4,300. Joining us now is Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities. Are you required to have price targets at your shop at BofA?
I don't know if it was written into my contract, but I feel like it's something we're all expected to do.
When do you do them?
So yeah, it's a great question. We do them, well, we're right about to start thinking about next year. So we usually launch our year ahead outlook in November, and then we have the luxury of being able to revise it as the year progresses. But it's kind of a silly number, right? It's a point in time target.
To do it, but
it's going to be wrong.
It says you're obviously it's at 4,450 and you're at 4,300, so you need to raise it at this point. But you're 4,300. When was that from November of?
No. That
when did you go to 43?
Let me think about this.
Were you dragged kicking and screaming to 4,300 too?
No. We started the year more constructive on stocks. We raised it once during the year to catch up with kind of like the Magnificent Seven rally in the first half.
Where had you been?
Gosh, I'm trying to remember. I don't want to give you the wrong number, but it was we were at every point.
You were at 3,600 by the end of the year.
No, we were not looking for 3,600.
You were somewhere above 4,000.
We were above where the market was trading at the end of the year for this year.
Okay, but
so we were expecting a positive return, but we didn't estimate the strength of mega cap tech. So that was our fail this year.
So now to get to, let's just assume that 4,600 is what you see as fair value. It might be a good idea to stay at 4,300 if something goes wrong, if there's a recession, this is a choice you're making.
This is a choice. This is a very concerted choice because I see far more bullish indicators for mid and large cap stocks than I do bearish. And what I think is interesting is that every day a new bearish narrative emerges. And I think that there are at least 5 reasons that you should be in stocks and mid-cap stocks and large-cap U.S. stocks rather than bonds or other asset classes.
Right.
And I'll give them to you right now. One is productivity. I think that has this AI theme is not just about AI and 7 tech companies. It's about a broader efficiency-driven earnings power for the S&P 500 that we haven't seen in a very long time.
Good for companies, but good for workers?
It is good for workers because think about it. Right now, we also have this mini manufacturing renaissance going on in the U.S. We've spent 10 years woefully underinvesting in manufacturing. But think about the grid, the infrastructure, all the spend that we need to support this AI boom that everybody's talking about. That's stuff on the ground that is bullish for industrials. It's bullish for machinery. It's bullish for oil. Even getting to net zero and decarbonization goals are very bullish for commodities along the way. So I think we're in an environment where we're all underestimating the bullish themes for the economy, for the stock market, and we're just focused on the fact that you can get 5% on cash.
So that's productivity.
Who cares?
You have 4 more?
I have 4 more.
You do?
And I hope I remember them all, and I hope I get time to say them all.
You might have a Rick Perry moment.
I know, you're never supposed to enumerate. Yeah.
Energy.
So there's a few more. One is sentiment. Sentiment is still very negative on equities, except for these mega cap tech companies. That's where the bullish arguments that I hear from clients are. Everything else is kind of neglected. I think what's interesting is that the Magnificent Seven now takes up over 40% in almost every fund manager's portfolio.
How much of a risk is that for the broader markets, though? If that was the the thing you got wrong about this year, about those being so strong.
Those being strong.
What if those turn around? That's going to surprise everybody.
So I think what's interesting is that those companies, we've got 6 out of 7 of those companies we have buy ratings on. These are fundamentally attractive companies, according to the experts, our fundamental analysts. These are companies that make money and they can return cash if they don't have as much growth. Like, I think what we saw with Meta at the beginning of the year was a really bullish sign for S&P 500 duration risk. Because what I was worried about is that a lot of the growth that you're buying in tech stocks is back-end loaded, and they're going to get hurt by a rising discount rate. What Meta did was they cut a bunch of costs, they fired a bunch of people, they did a huge buyback and pulled a lot of cash forward and returned it to investors. And I think that's the saving grace of stocks, is that companies have options. They can navigate.
So they responded to the changing market.
They responded to a change in macro, exactly. And I think that's what's really exciting about corporate America, is that they're adapting. They're spending on automation in the face of higher inflation. So we have this tight labor market. We have an aging population, but now companies get it, and they're like, okay, we need to.
You also have strength from unions, though, too. UAW and the strikes.
UAW
that's the flexibility.
So this is the negative headline that everybody's focused on. But what this actually says and points to is an underlying shift from just financial asset inflation that benefited luxury goods and markets and, bonds and every asset class in real estate, to an environment where we're seeing a broadening of income, which is actually bullish for the cyclical companies in the S&P 500. The consumer discretionary sector in the S&P 500 is much more geared to middle income spend than to luxury. Luxury is Europe. Those stocks have done really well. Now come back to the U.S. and buy some middle income spend, because real wage growth just inflected positive. People are making money. Manufacturing drives jobs. I mean, I feel like I sound a little bit like a politician, but I do think that there are a lot of really positive themes right now for the broader market beyond just AI and the magnificent.
Would you do 4? How many did you do? You do all of them?
Have I done all of them? I feel like there were more.
Forgot the energy department.
Neglected. What's that?
No.
I forgot energy.
The energy department. You're closing that one down, too.
I do like energy stocks, by the way. But I do think that we're at a point where the market's hated. The equal weighted benchmark is actually pretty cheap. So if you look at valuations for the S&P equal weighted benchmark, 15 times. That's not crazy expensive, especially if inflation is coming back down to around 3 or 4%. We've got a Fed that's hiking rates. But if you think about what happened, okay, so I want to give you guys an example of a period that was great for equities and was accompanied by very strong productivity gains. If you think about the market from 1980 to 2005, we had massive labor efficiency gains. We saw companies get very labor light. Automation was a theme. And over that period, the market returned 15 percentage points of total return per year. Real rates were 3.5% on average. Right now they're 2, and people are freaking out. They could go to 3.5, and things are still okay. So I think that's what we all forgot about, is that rates can actually move higher, and equities can handle it. Maybe bonds.
Even businesses can exist in a, and it's good that money has a cost, because when it's zero, too many bad things happen.
It removes all of the fake zombie companies, which are drifting into the Russell 2000.